Welcome back to Learn SKN, and today we're going to pick up right where we left off on the previous CSEC economics video. So the previous video we looked at the role of the central bank, we looked at the many different things that the central bank do, and so we're going to just jump right back now into the monetary policy and the instruments used by the central bank to carry out their monetary policy, and we're going to see how these instruments affect the money supply. Remember, monetary policy is the manipulation of the money supply to achieve certain broad economic objectives. And so we're going to go back and look at the tools that the central bank use to control the money supply, monetary policies. That's why, so they have them here. So we're going to try and break them down. So the first one, let's say, is the interest rate, right? The interest rate. Now, the central bank can determine what interest would be given on a loan, right? At a commercial bank level. So, for example, if the country is, let's say, the inflation is high, then they would have to manage the interest rate. If inflation is high, then you want to carry up the interest rate. What does this do? If you increase the interest rate, that means that money becomes expensive to borrow. And if money becomes expensive to borrow, then that means that nobody going to the bank for a loan to spend on anything. That includes businesses. And so businesses are not going to go to the bank for credit to invest. And if you're not investing, then you're not spending any money on certain certain projects and things like that. You're not installing anything new to increase your production capacity. So therefore, you pull back, and so demand should fall, because where you realize that you're not spending the money that doesn't belong to you anymore. So you control the interest rate like that. So if you want the economy to have a certain reaction, then you would rise the interest rate or lower it based on what reaction you want. If you want to spur demand, you want to increase, you want to get the economy going, get people buying and stuff like that, what you do as a central bank, you would lower the interest rate so that borrowing becomes cheaper, and so everybody and their friend gonna borrow money to buy this and buy that and buy the other. Even businesses, when it is cheaper to borrow money, they go borrow money, invest in new machinery, invest in this, in that, and then the productive capacity increase. Same way, people gonna have more money in their hand to spend, and so demand will increase. So the economy is a cycle like that. But it's not like the central bank would just say, hey, this is the interest rate, go. Right? What would happen is that they would change. If the commercial bank borrows money from the central bank, then based on the interest rate that the central bank is charging the commercial bank, then the commercial bank will in turn charge the interest rate to the customer. And if it's high, then the economy going to slow down, things going, inflation going down. If it's low, it's to boost the economy, and so a lot of people going to come borrow and spend a lot of the money. And I think this is one of the examples outlined here in the textbook, where they're talking about deflationary and inflationary tactics. So let's read what the book has here. When there is inflation and the economy is overheating, the central bank will implement deflationary monetary policy, meaning that the economy, things are just getting out of hand, everything expensive, a lot of people got money, they're buying a lot of stuff, demand is extremely high. So if demand is extremely high, price going up, it's getting out of hand. So they want to cool down the economy, pull it back a bit. So they will implement what you call deflationary monetary policy, bring down the prices or stabilize the prices. For example, it might increase interest rates, as we said before. This will reduce borrowing by firms and individuals, and then investment and consumption in the economy will fall. This will reduce aggregate demand, that's demand on the economy as a whole, and national income. Inflation will fall. This is summarized in this diagram right here, and every diagram showing it right here. Central bank increase repo rate. Interest rates of commercial bank rise. Investment and consumption falls. Aggregate demand falls. Demand pull inflation is reduced. So the repo rate, again, is the interest that the central bank charges the commercial bank to get some funds. So this is summarized. Okay, that's the figure. So the Central Bank of Trinidad and Tobago raises the repo rate or repurchase agreement rate from 6.75% to 7%. The repo rate is the rate at which the central bank provides overnight liquidity, so they borrow money, to commercial banks. This is an opportunity to convert assets to cash. As the repo rate rises or falls, whichever one to choose, the interest rate will rise or fall. This was done to combat rising inflation, and so they have both extremes right here, right? So the repo, so that's what they use right here, the repo rate, and that would affect, of course, the interest rate. So the repo rate, that's how much they lend, the interest rate they lend the commercial banks the money at, and that would in turn affect the interest rate that the commercial bank can charge, and that will affect how much money persons want to borrow. Then they have an next example here. When there's unemployment and low national income, so this is the opposite now. The economy, the central bank would implement expansionary monetary policy. For example, it might decrease interest rates. This will increase borrowing by firms and individuals, and then the investment and consumption in the economy will rise. This will increase aggregate demand and national income. Unemployment will fall. So that's the opposite now. So they decrease the interest that they charge in commercial banks to get money, and they would in turn, the commercial banks would in turn reduce the amount of interest they charge in borrowers. And borrowers is both people and companies. And so if a company can get money for cheap, then they would borrow, invest, and when they invest, consumption would rise. And even when they, not only them investing would rise consumption, but people have access to money now. And so their demand would rise, and the companies would answer the demand by expanding production, and so the economy would start going again. So when you have a recession, they would lower the interest rate to try to boost the economy. When you have when it is it's overheating, you have a real boom, then you would increase the interest rate to reduce borrowing and cool down the economy. So that's that tool what you call that's what they use the interest rate, right? That's what they use the interest rate to control the money supply. Then you have what you call the reserve requirement. The reserve requirement. Now for the reserve requirement, remember we said earlier that each commercial bank, they have to keep a certain amount, a certain percentage of money with the central bank. Now what does this mean? This means that it would reduce the amount of money that the commercial bank has available to it for itself to loan out to customers, right? So let me not say reduce. It affects the amount of money that the commercial bank has to lend to customers, to loan. So when I say affect, where I change from reduce to affect is because it can be both ways. It can either reduce or increase. So let's say that the central bank wishes to, let's say the economy is in recession. Demand is down, unemployment is high, it's in recession. If they want to try and boost that economy, they can now tell the commercial banks, okay, look, instead of keeping, let's say, 50% of your reserves with us, you're allowed to now keep 25. So now the fresh 25 gone in the bank's hand now. So the bank had what they had before plus the 25. So that means now the bank has access to more money. And if they have access to more money, what does that mean? They can loan more people money. So they have more access to money and they can make additional loans. And now if you can make additional loans, that means that you will put money in more persons' hands. And so if money is in more persons' hands, more companies' hands, they can help to boost the economy. Invest, demand increase, that kind of thing. So they can help to boost the economy. So that's how the reserve requirement works. And the opposite is true. If the central bank realizes, okay, inflation high, unemployment, demand is too high, economy overheating, let's slow it down. What they can always say, okay, commercial banks, I will take your reserve requirement from, let's say, 10% up to 20%. So you have to keep 20% of your money with us. What this does is take out money out of the commercial banks. So now they have less money to lend. And if you have less money to lend, then that means that it's not enough money out there to go around for persons to invest and buy and increase demand and stuff like that. And that would slow down the economy, right? That would slow down the economy. So that's how the reserve requirement ratio works. And so I have it right here. Reserve requirement ratio affects how much money banks can create by making loans. To increase money supply, the Fed or the central bank reduces the requirement ratio. Banks make more loans from each dollar of reserve, which increases money multiplier and money supply. And then the reverse now. To reduce money supply, Fed raises the requirement ratio, and the process works in reverse, right? So that's how the requirement ratio works as a tool to affect or to manipulate the money supply. All right, so that's how that one works. Then you have what you call open market operations. Open market operations. Well, what are open market operations? Now, this is another tool that the central bank can use to manipulate the money supply. That's another tool in their monetary policy bag. So they pull one out of the bag, and they do it often. Now, what is the open market operations? Now, this has to do with bonds and things like that. Where based on what the Fed or the central bank is trying to achieve, it will affect what they do in terms of the open market operations. So let's look at what they say here. Open market operations, the purchase and sale of government bonds. So in this case, looking at the US thing, so government bonds by central bank. 1, to increase money supply. Here it happens now. To increase the money supply, to get things up. Now, remember we're saying that the economy might be down right now because things brown, we're in a recession. So if you want to get money in people's hand now to increase the money supply, what the Fed can do or the central bank can do, they can actually buy government bonds. So they can buy government bonds from people out there, paying with new money, new dollars, which are deposited in the banks, increasing reserves, which banks use to make loans, causing the money supply to expand. So you see what they do there? When they want to increase the money supply, by using open market operations, what they do, they buy bonds. If you buy bonds, that means you're giving me the bonds and I give you money. So I'm the central bank. I'm going to buy the bonds from you. So I take in the bonds from you, and in exchange, I'll give you money. So what is that doing? That is putting more money into the money supply. So it's increasing the money supply. As if the money supply is increasing, that means more persons have access, more business have access to more banks have access to more money, and so they can lend more, make more loans, people can invest more, and so they can increase the money supply and cause the economy to start rolling again. Now the reverse is also true. If the economy is overheating, things getting tight, inflation going crazy, what they can do now is sell government bonds. So they can offer you a nice deal. Okay, come buy these government bonds for X amount of years at this interest rate. Make it sweet and attractive. So what people are going to do now, they're going to go and buy the bonds as an investment. And when people give up their money for bonds, you can't spend the bond right there, just like that. So you're taking money out of the money supply. So you're reducing the money supply, right? So you take money out of circulation. And what would happen now is that you have less money circulating. And so therefore the money multiplier effect would reduce. And so commercial banks have less money to lend. And we said it before, if you have less money to lend, then money is no longer cheap, kind of expensive, not enough to go around. And so the economy would actually slow down, right? So that's how we control the economy with monetary supply, with the open market operations, the interest rates, and the reserve requirement ratio. And then this other one here now we have here, you call moral suasion. Moral suasion. What is moral suasion? Simply put, moral suasion is simply the bank trying to talk to you. The central bank trying to talk to you, talk to the economy, talk to the producers, talk to the banks, just to try to sway them, right? Try to appeal to their morality, to do what they want them to do. So if they want, banks to free up capital, to free up credit, they might go out and give a good speech and say, this is time for banks to do this and, have a heart, be good to your fellow man, whatever. So whatever they want to say. Or if it's the reverse and things are going out of hand, they might say, no, man, this is time to get the prices down. We might be, increasing the interest rate. So it's just them using their voice to try to persuade the players in the economy to do what they want. That's how moral suasion is. So they're trying to persuade persons in the actors in the economy to do what they want them to do. So they're not going to use any tools like the interest rate, whatever. They're going to just talk. And so you realize that means that they have a lot of power. Because if you follow like Bloomberg and those kind of channels, and you see the Fed chair come and talk, based on what the Fed chair say, right? that would actually affect the stock market, you know. So stock markets can go up or down just based on what the president or the CEO or whoever of the central bank says. So they have that kind of power in their voice, in their tongue. So they can actually talk, and based on what they say, that could really affect the economy. Sometimes you see stocks going low, going high, just based on what the head of the Federal Reserve say. So that's what you call moral suasion. So that is why you can't, some of these heads can be reckless with their mouth, you know, because you can't say certain things, because you're going to have ripple effects throughout the economy. So you have to watch what you say, because people are actually listening. And so that's about it for the functions of the central bank. And as you can see, supervising other financial institutions, we looked at that already. So that's about it for the functions of the central bank. So we can check off subsection 5 in section 5. So we done that part. We looked at the role of the central bank, and we outlined the tools that they use to achieve certain broad economic objectives, also known as their monetary policy, right? So that's it for now. So the next video we're going to be looking at would talk about the other financial institutions, commercial banks, stock exchange, credit unions down the line, all right? So that's it for now. Thanks for watching. Thanks for listening. Now, I would recommend that you go and watch the POB video. Look at the POB playlist, watch a video on the central bank. That might give you a little more clarity. But for those economic students, you can just go and watch some of the previous videos that I would have made. All right, so thanks for watching again. Thanks for listening.